TheoTrade. This is Don Kaufman. It's July 6, 2019, and you are watching the TheoTrade Weekend Update. You know, in a few moments, I'm going to be answering this question, really, in the first half of 2019. Was it effective to be buying options premium or selling options premium? Prior to that, though, I want to hit a couple of key points in this video section. Then we're going to jump right into a couple of charts and trade ideas. To begin with, the S&P 500, well, it hit the oh-so-important 3,000 level. I have to tell you, it comes during this anticlimactic, holiday shortened trading week. We only had 3.5 trading days this past week, obviously because of the July 4th holiday. Nevertheless, a whole lot of action inside of the week. I mean, there was about a $53 expected move, and we hit every ounce of that and then some. Nevertheless, though, we closed inside the expected move on the week. So hitting this 3,000 level in the SPX kind of raises the question. Is the Fed going to accommodate? I mean, I hate to, every time I come on a video now, I hate to discuss it's Fed this and Fed that, but it's the Fed versus the rest of the world. And, in terms of central bankers versus the rest of the world, that economically things are slowing down around the world. But here, for example, we got the jobs number on Friday. That too was a little anticlimactic. It was 224,000. Again, old news, but it reinstated the good is bad narrative. Effectively, what I'm saying is a good jobs number, and this one was spectacular. It kind of overshadowed, of course, last month's job number, which was not so spectacular. Nevertheless, this is a good jobs number, which was felt as bad for the markets, and you saw the S&Ps dive a little bit. Net, they only closed down about 8 handles on Friday's trade, but you have to recognize what we're looking at over here. So the end of July, this month, July 31st, the Fed's of course going to meet, and what are they going to do? Right now, the markets are pricing in effectively. They are absolutely, unequivocally going to cut interest rates by 25 basis points. I mean, but you have to recognize this is not prototypical conditions for a rate cut. I mean, what do you have over here? Well, we have unemployment at about 3.7%, which is the lowest it's been since 1969, but it's all right. It's, it's good for a rate cut, and they're going to cite inflation. Now, if the Fed is going to backtrack at all on the idea of a rate cut in July, it's got to be this coming week. The Fed actually goes into a blackout period prior to the Fed meeting and announcement. So they're allowed to speak this week, and specifically Jerome Powell will be testifying this week in front of a couple of different congressional committees, which should be exciting, which again kind of brings me to this point. Good jobs number, it's also indicative of a stronger dollar, right? And again, it softens the Fed's ability to be aggressive and to want to cut. So I think there's a lot of kind of controversy in the markets this next trading week, which should bring up a degree of the volatility, which is kind of ironic because the volatility in the S&P right now, the SPX, is displaying lower than it has in literally in months. We're looking at a $33.70 expected move this coming week. So we just came off of a $53 expected move, about a $53 expected move in 3.5 trading days. So the marketplace was looking for this $55 move. It got an error, $53 move. It got every ounce of that. Now we're looking for just over a $33 move in this coming week, and we have 5 full trading days, and we do still have quite a bit of economic news. We have Fed speak going on. We actually have Fed minutes. We have ECB minutes. I mean, I could spend 20 minutes just talking about all the stuff that's coming out. So just because it's a summer week over here, hey, listen, Jerome Powell is talking. Again, it's the entire world and global economy versus central bankers, and the key central banker, he's talking this week. So with that, let's get into a little bit of some of the charts and some of the trade ideas here. Specifically, again, I want to cover what we have learned from the first half of 2019, specifically about options premium. I think you'll find this rather insightful. With that, let's get to it. To the charts and trades we go. We're going to start this weekend's update specifically here in the SPX. We're going to talk a little bit about expected move, and we're going to jump right into answering this question. What did we learn from the first half of 2019? And again, this is in regards to options, and really to get specific, should you net be buying options premium, or should you be selling options premium? With that, let's get to work here again in the SPX. One of the ways that I like to dice up the chart, which is a huge amount of information, is to use these expected moves. Now, what you're looking at on the screen, all the little hash marks on here, it's just the week to week expectation, okay, of price movement, okay, depicted from the options market. I'll just give you a kind of a quick example of this and kind of script it out for you a little bit. All right, what we have here, this is the coming week expected move, right? Now, obviously, the week has not yet unfolded, but the options premium, okay, is set from Friday afternoon's trade. It's set this right here, okay? This is where the week started. This is the upper edge of the expected move, the lower edge of the expected move. Now, here, and only here in the SPX, I literally painstakingly hand draw each of the expected moves, because for some of my own research, I want to be deadly accurate with this. Now, where do I actually derive this expected move from? Well, that actually comes from right here in the SPX options chain. I'll open up in this example like July 12th. Okay, there's a 10.26 volatility with just about a $33.70 expected move. Now, all I'm doing is I'm taking the Friday expected move, okay, and plotting it here in the chart. I mean, what this really kind of breaks down to is we're saying, all right, we'll just draw a nice distribution curve here. We're just saying like, hey, right now, this is where we currently are. When I say this, right now we're at 29.90, okay? We're supposed to move up, we'll just call it $33, or down $33. And you're supposed to stay in that range approximately 68.3% of the time. Now, again, I've kind of diced this on a weekly basis. So what can you learn from this? Well, first of all, there's all kinds of trades you can build off the expected move. One of them is we actually can lay butterflies right on the edge of the expected move. We've got a full class on that. We've actually got earnings-related expected move trades. But the bottom line with the idea of expected move, and I'm going to zoom out right now for a second, is you can see these little kind of like, highlighted areas. Those are where the marketplace not only breached the expectation of price movement, okay, but where I highlight would only be at the end of the week. And it's only to display a close of the market at the end of the week outside of expected. So for those of you that you really want to geek out, I'm talking to the engineers, right? If you really want to geek out, you can actually count through and kind of go 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. There are currently 10 closes outside, and we're halfway through the year. So you can say, all right, in 26 weeks, just again, kind of rounding over here, in 26 weeks, how many times do we close outside the expected move? And of course, you can come up specifically with a probability. But there's so much more going on than just like, okay, does it come out to what? What was it supposed to be? Well, if you take enough occurrences of this, you should be, okay, inside that expected move, inside the expected move, right? Inside the expected move about 68.3% of the time. Well, I can actually go back into literally, I've been hand drawing them here for we're coming on to 3 years. So we can actually go back and we can look at every ounce of data. But we've also built a script on this front, and that script can help immediately calculate this. You don't have to sit there and like painstakingly go through in every single underline. I just needed absolute incredible accuracy. The interesting thing is that when you do go back and you start counting it As I said, we have like 10 breaches this year. But if you go back and you actually count a huge data set, it really does come out to about 68% of the time. But the problem with this is, when I say 68% of the time, again, we're supposed to stay inside that range, okay, 68% of the time. The problem with that is, just because we stay in that range 68% of the time, it doesn't say I should sell premium. Because what a lot of people miss is when we breach, okay, we might go to a 2 standard deviation move, we'll call that 2 sigmas, or even a 3 sigma move, even a 3 sigma move. And what you'll find out in a whole lot of underlyings, all right, here specifically since the beginning of 2019, there have been wild 3 sigma type moves happening. Now, not everybody that's tuning in, okay, sells options premium on a week-to-week basis. So with that, let me kind of clear the board and give you an idea. I'm actually going to clear the board. I'm going to go over to the spiders right now. I'm going to get rid of, we don't need no stinking volume down below. Just go to equities, get rid of volume, hit apply, hit OK. I just want to throw up a year-to-date percentage. So again, let's assume that you're not selling options premium on a week-to-week basis. Maybe you're selling options premium for a month. Maybe you're selling options premium for 6 weeks. Now, I want to extract any directional bias from what we're about to discuss. Now, a lot of people will go out and they'll tell me that in 2019, okay, they sell puts. Well, selling puts, it's fine. Selling puts is a positive delta trade. Effectively, that's the equivalent, okay, of being bullish. So you're bullish, you're selling puts. If you sold puts and sold puts and sold puts and sold puts and the market continued to go up, okay, selling puts, not disputing that, probably made money. Not though because you were selling the premium. The sell of the puts made money, okay, simply because you were positive delta. It had nothing to do with the sale of premium because, as we know, premiums are fairly low. Now, what I want to show you is there edge on the buy side of options premium, okay, or again on the sell side of options premium? Now, one of the ways I'm going to do that, and again, I'm going to get rid of this in the equities. We'll knock off that volume again, okay, here. Thus far on the year, we're up about 19.3%, okay? That's in the first 6 months, which are some stellar returns. But if you looked back, right, was the option market volatility depicting, okay, a 19% move? You know, there's a lot of different ways to kind of come to a summary of this. I'm going to give just a kind of a what I would call a quick and cheesy way, and then I'm going to go much more in depth. So just bear with me here. We're going to take historical volatility, which is the annualized standard deviation of the past stock price movement. Now, when you pull up historical vol, it's going to average it over a 20-day rolling period. And I say this is kind of a cheesy way to do it. And then we're going to come over here to volatility studies, and we're actually going to throw implied volatility in there. Now, once you've got historical volatility and implied volatility, first of all, one of the things that you have to start to recognize about the two of them, they can, in fact, be compared. That is, when you start looking at, like, you know, historical volatility, which right now is all the way down basically to 8.6%. Now, that's 8.6%, but that's average over the last 20 days. That is actual price movement, meaning the market's moving at a rate of, 8.6%. Now, the implied volatility is still denoting, okay, about 13%. Now, this implied volatility right here, okay, that happens to be a 30-day IV. That's what's charted here on thinkorswim as a 30-day IV. So you're like, oh, look at that, man. You can sell all kinds of premium because there's edge. All right. So if this is a very common mistake, implied risk, all right, is showing a 13% at a rate of 13% movement. Okay. Actual movement is 8.6%. However, when you start to compare them on the year, all right, and there's a great way to do this. You could just actually just take it and superimpose one onto the other. Hit apply, hit OK. Just throw them into the exact same chart. What you're going to find in a whole lot of cases is that the historical volatility, which is actual price movement of the marketplace, it exceeded implied in, again, a lot of cases. Now, as I said, this is kind of a cheesy methodology of effectively doing this, but the one that I prefer to do, and again, I'm going to take you through the most detailed methodology here in a moment, but what I actually prefer to do, kind of make this argument, is look, the spiders are up 19.3%. Okay, what is the best indication of volatility for the S&P 500? I would say that 30-day volatility in the S&P 500, the best indication would be to use the VIX. Now, what does the VIX really say? Okay, and I'll just show you. Okay, if VIX, okay, is at 20, if the VIX is at 20, that's the standard deviation. That's supposed to be the price movement for these spiders. So if the spiders are trading right now, right at 300, it says, well, we're supposed to be able to move up 20% or, again, down 20%. Now, if you take a look specifically into just the beginning here of 2019, the volatility has obviously collapsed quite a bit, but the average VIX is nowhere near the 20 level. It's nowhere near the 20 level, the average VIX. I don't even have to pull up a study like people are like, can you put a moving average on that? No, I can't, because it's nowhere near 20. But the S&Ps, okay, are still up just shy of 20%. So I think that this, even though this is like a very simplistic way of doing it, okay, I think it's also the most cut and dry way of doing it. Listen, you have a marketplace that moved up, let's call it roughly 20%, except its key volatility indication, all right, was nowhere near 20%. So in the battle versus good versus evil, and should I sell premium, should I buy premium, without unequivocation, okay, in the spiders, being a premium seller was the death of you. Now, again, I argue that you could have sold puts, and selling puts would have absolutely made you money, but that's not because you were selling premium. That's because you were delta positive. So net, you're selling puts. All of a sudden, there's one big drawdown, and you're going to find out, okay, in that 68, and again, this is really important. So you get this person selling puts, okay, but they're going to find out in this 68% of the time, you're going to find out what happens down here and up here. You're going to find out what happens to the person 16% of the time. 16% of the time we get rocked. Hopefully it's not a 3 or even a 4 sigma move. Now, allow me to geek out on you, because the first answer that we have in here is that absolutely unequivocally, okay, being, okay, positive gamma or a long gamma trader has paid, all right, in the first half of 2019. Effectively, what I'm saying is net, you want to be a buyer of premium. Now, as I said, I want to geek out a little bit on you. Now we're actually going to bring up the XLF. Okay, and we're actually going to pop in there what's called auto expected move. What does auto expected move do? What it actually draws is expected moves. These are weekly expected moves. Now you can change almost every variable of the script in here. But as I zoom in, okay, to this, what I want you to see is this actually marks right there, those little dots, they mark the breaches. So we actually have dots to mark touches, dots to mark breaches of expected move. So in this particular script, and this script is readily available to all TheoTrade members, okay, in the script, it'll immediately go through and count everything for you. So you don't have to go through here and go, look at this. I like, again, in the battle of premium buying versus premium selling, look, that's a breach. That's a breach. Oh, this one remained inside. That's a breach. That's a breach. This one remained inside, okay? That's a breach. Look how often, I'm just zooming into some of the most recent weeks of trade. Why not? Right? You just learned in the XLF, it's a nightmare. Look how large some of the breaches have been too. Look at that. We're talking like 3 deviation territory, 2 deviation territory. This is almost 4 deviations. It's insane. Big, wild moves. Again and again, all I'm doing is just, briefly kind of highlighting. Look at that. That's a perfect touch. I'm just briefly highlighting all the significant breaches of expected moves specific to the XLF. Now, you can run this on anything you want to run it on. You can come in here and go, well, how many times did Facebook do it? How many times did Apple do it? All right. Me, I like to use some of the major ETFs. All right. And as I said, there's a lot more data points that you can add in here. When I say data points, you can come right up to this script, and the script built within it has all these bubbles that you can turn on and off. And you're like, well, what exactly do you mean like that? Show high, low detail. Just put in yes, right? Hit OK, hit apply, hit OK. All right, with high, low detail, then what we're doing in here is we're saying how many times did it close over the expected move. It's amazing because when we just talked about the standard distribution, okay, we learned that 16% of the time, we're going to close outside. You know what it did? Over the expected move percent was 16% of the time. But then things get a little nutty. All right, from there under the expected move. What you find out though is even though in the XLF it fit this 68% of the time, okay, the moves that happened outside the 68% of the time were shockingly large. Even that can kind of be summarized from some of the data points here in this expected move. I go, this stuff, the first time I show this, right, and I think this is the first time I've really done the really in-depth video in a very, very long time about this expected move, but you can come in here and you can even show the daily high and low. Yes, watch this, hit apply, hit OK. Look how many data points you can actually hit, all right? So, how many times on a Monday did it go under the expected move? On a Tuesday, okay, on a Wednesday, all right, on a Thursday over the expected move. You can actually break it down literally on a day-to-day. Why would you want to do that? Because as I said, I don't know if you're selling premium for a day. I don't know if you're selling premium for a month. All I know is I can dice it any way you want it. And no matter how many underlyings that I've gone through and how many underlyings that I've looked at, what you're going to find out here is that you really do want to be net long gamma. That's selling options premium. Again, all directional bias aside, selling options premium in the first half of 2019, again, without unequivocation, has not been, okay, all viable. It hasn't been all rosy. Here we have, again, none other than the Qs, the Nasdaq, and we can look again at a number of what appear to be minute breaches of expected move. And then things get hideous in a hurry with, again, a number of key breaches. And it's all about, okay, not just about probabilities. When somebody says 68, it's about magnitude. It's about how far did we breach, okay, the expectations of price movement, either on a week-to-week basis, a month-to-month basis, or, like we've just pulled up here, 6 months of data. With that, again, expect some volatility this next week of trade, even though the expected move this week, I'll reiterate that, is like $33, okay? There's a whole lot of news out there. Listen, summer trade, push it aside, okay? Summer can wait. Right now, we've got ourselves some volatility. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.